Good afternoon, all. We'll wait for a few minutes because I think there are only about 15 of you all there. We'll just maybe wait for a couple of minutes and then we'll start. I'll pause the recording. I'll start when we. So, any questions from yesterday? Do you all have any questions from where we finished off yesterday, or it's all fine with you all? Okay. Since nobody seems to ask anything, I'm assuming that you're all fine, and then we can kind of start off. So the rest of the course, or for bulk of the course now, what we are going to talk about and look at is how do we manage this risk. Now, and why do we use derivatives? And derivatives is one tool to kind of handle this. Why do we use this? And how do we manage this is the question that we would like to answer. And the point out here is, realize you will actually have to have a contract which will kind of be giving you a payoff under certain circumstances, not under all circumstances. Because see, in some cases, the outcome that you get from the market is actually a positive outcome, is actually an outcome which is good for you. So, like as I said, if you expect the return to be 20% and you get a 50% return in a scenario, you would not want to create a model under which you will sacrifice the extra 30% return that you're making. You would want to take that extra return. However, if it kind of goes down, that is where if you start potentially making a loss or not earning as much as you thought you would, that is when you would want to have a protection. So you would need to pretty much, in most cases, want to have a product to protect yourself in such a manner that, as far as possible, I'm not saying it is guaranteed, but as far as possible, the upside is yours to keep, and it is when the downside happens that the protection mechanism comes into play. So it is not that you will lose the upside. Ideally you would not want to lose the upside, and you would want to keep the downside. You would want to kind of take the downside as far as possible, and keep the upside. Reduce the downside and keep the upside as far as possible. That is where pretty much the argument of derivatives come into picture. The other reason why derivatives come into picture is also the point I was making yesterday in one of the slides and one of the examples that we had. Remember, if I believe, so that dynamic argument, so if I believe that nothing is going to happen, my position is always going to be positive, I'm going to be happy about it, I'm going to make money, there is no, and which essentially implies there is no need for me to cover myself in any way, my returns are always going to be positive. If that is the case, and if I believe in it very, very strongly, I will not, take any action. I will not enter into any product or any framework to kind of cover for my risk, because I do not believe, or I'm strongly of the view that there will be no adverse risk on me, which means the chance of me making a loss is very, very remote, and in my opinion, does not exist. So why do I want to do something? Because any action that you take, remember, comes at a cost. So there is a risk hedging or a mitigation cost that we will have to pay. If your view comes true, which is that there is no loss, the cost of hedging, the mitigation cost, is essentially a direct reduction or an amount that you will have to take out from your profits, and that would lead to lower profits. So why would you want lower profits? Doesn't make sense, and hence you will not do that. On the other hand, if you and therefore you will not do that. However, if your view comes wrong, and therefore, then you'll have to bear the entire loss, and that loss could be large. So let me give you an example. Let's say you have agreed to sell, shares of a company to a counterparty 6 months from today at $50 a share. Now, you believe that the share price will not cross $50, and therefore you are happy doing nothing, because you know you will earn $50 a share. Your belief is that the share price will be below $50. So even if you have to buy it in the market, you will buy it at, let's say, $45, $46, and you will sell it for $50. You make a profit of $4, $5, whatever the case may be, per share. However, if your view comes wrong and the share price actually crosses 50, how much can it go up to? How much can the share price go up to? Once it crosses $50, how much can the share price on the upside go up to? To any level, to an infinite level, essentially. There will be no limitation to the amount of share, to the amount to which the share price can rise by. And if that is going to be the case, if there is no limitation on the amount the share price can rise by, the potential price could also be very, very large. Now, if I have to deliver the share, which means I'll have to buy the share in the market and deliver it at the fixed price of 50. If the market price is below 50, you are making a profit. When the market price goes above 50, realize you will have to buy it at a price higher than 50 and sell it at a price of 50, thereby making a loss for yourself. And this loss could actually be very large, because the amount to which the price will increase is not known, or is kind of it is kind of open-ended. So therefore, you could actually suffer a huge loss. On the other hand, take the other side. The other side is also not a problem. Now, if I believe that the share price will definitely, in the same example, another person comes in and says, I believe the share price will necessarily cross 50. So what can I do? I can buy the shares today at, let's say the current price is 47 or 48. I buy the shares today at 48 and hold on the shares. What is the idea? The idea is I bought the shares at 48. I will hold on the shares for whatever period, and at the end of the period, be able to sell it for 50. Therefore, make a profit of $2 per share, well, adjusted against the cost of carry, which is the interest cost. This guarantees me, or this protects me from the fact that if the price goes above 50, which is what I believe, I will now have been able to have bought the shares at a price below 50 and then sell it at 50, so I make a profit of 50. What if this view also comes wrong? In other words, the prices, instead of going above 50, actually crashes and goes below 50. Right? If that happens, the counterparty is not going to buy the share from you, because the counterparty can now go into the market and buy the share in the market at a cheaper price. And if the counterparty now what is your problem? The counterparty does not buy the share from you. The counterparty buys the share from the market. You are left with all the shares that you had to transfer. You are not in the business of holding shares. You had bought these shares to cover yourself against potential future payments and potential loss that you might be exposed to. So you have now got stuck with shares, and as the share price goes down, when you go to sell in the market, you start losing money in that process as well, because you have bought it at a certain price. If the price falls below that, then essentially you are losing money in that process as well. So both the scenarios will lead you to being exposed to losses upfront, and then uncertain, and the size of the loss could actually be very large. You are uncertain as to how much the price will rise by or the price will fall by. So therefore, you cannot really run the process in such a simple, static manner. If you could, life would have been very simple and easy, and people would have been happy about it. But the reality is that you will not be able to run it in that simple, static manner, and you will actually have to use some more complicated products, which is where the derivatives products kind of come in. So what is a derivative? What is a derivative? Fundamentally, A derivative is a security whose value depends on other more basic variables. So a derivative security is essentially a security whose value depends on other more basic variables, or which are called underlying variables, some basic underlying variables. So another way of looking at derivatives is that it is a value of a contract. It is a contract which was obviously any contract depends on other factors. So this is a contract that depends on other factors, other variables, which are essentially referred to as the underlying variables. So if I were to give you an example, you want to buy a new car. The car will come into the market, let's say in another 3-4 months time. So what do? You go and you want to book the car so that you want to go to the dealer and book the car so that you are among the first people to get the car once it is launched. The dealer says, well, to do that, you'll have to pay me a certain amount of money in advance. Now, the question that you have to answer is, and that is where the underlying security story comes in, how much cash, how much money will you pay the dealer in advance? How much should you pay the dealer today in advance, which will allow you to kind of get that benefit of booking the car and getting the car once it's launched. Now, I don't know how much it will be, but obviously you can argue and you can easily understand that it will be a function of the price of the car. It will not be an independent number. It will not be something random. It will be a function of the value of the car in question. So that is the basic underlying variable that you're talking about. If you want to buy a Toyota, your amount of money that you need to put in will not be a function of a BMW or a Merc, right? But if you want to buy a Merc, in the same way, on the other hand, it will not be a function of the price of a Kia or a Toyota or whatever. So inherently, it will be the effective underlying variable that will matter, whose price will kind of define how much is the premium that you have to pay. The premium is of the derivative contract. The premium is essentially nothing but the value of the derivative contract. And hence, you realize the value of the derivative contract is dependent on the premium that you actually have to pay, which is fundamentally based on the price of the underlying variable out here. Now, look at this. This is an example, a simple example, where the foreign currency is the underlying variable. So I've just taken an Indian example. If you want, you can replace it with a Vietnamese exporter or a French exporter or anything, doesn't really matter. You are likely to receive $1,000 after a month, and you want to lock in your position. You go to the bank and you enter into a contract to sell the USD, 1,000 USD at a certain exchange rate 6 months from today. Oh, sorry, 1 month from today. So what you've done, you've entered into a contract which will allow you to sell the $1,000 to a bank, and the amount of money that you will get for this $1,000, essentially, in simple terms, the rate at which you can exchange this $1,000 is frozen today. And in this context, I've just taken the Indian example and I've taken it to be what we call it rupees or RS. It is nothing but 80. So for $1 is actually 80 rupees. Now, if you do it in Vietnam, it will be probably VND. I don't know how much is it now. What is the US dollar exchange rate? 21,000? So what is the exchange rate? I said what is the exchange rate between US dollar and VND? So how many VND will one US dollar get you? 23,000, right? Okay, fine. So essentially replace 80 rupees 80 by VND. You have the term out there, RS80. You can replace the RS80 by about 23,000 VND. So what happens is you are entering into a contract which will give you the right to buy the share, to kind of sell dollars to the bank 1 month from now, and for which you will earn 23,000 or maybe 24,000 VND. Right? Now, what have you done? You know that this value will, this exchange, the amount that you are entering into is the contract that you have entered into, which allows you to take care of the exchange rate, and that is essentially a simple example of a derivative contract where the underlying is the foreign currency. The underlying is essentially the foreign currency. Just okay. So the underlying is a foreign currency USD, and then you have a future value that you're kind of taking. Now, very quickly, this gives you a small very quickly, this kind of gives you a small history of derivative contracts that are there. These are not the only ones. There are obviously more derivative contracts that have existed around the world over a period of time. There is more that kind of has been there, and these are some examples. Right? These are some examples of. These are some examples. So you've had it in Greece. So if you look at it, one of the earliest examples that I have out there is the example is that in Greece, where way back in about 332 BC or in the 4th century BC, you've had this example of just 1 second. Tran, is this better? Tran, is this better?
Not yet, Professor. I still cannot see.
You cannot see me at all.
Yeah, it shows like a totally dark.
1 minute. Is it shared? Just 1 second. Guys, just 1 second. There is this thing they need to kind of.
Yeah, sure.
Now?
No, I cannot see anything. It's so strange. Professor, can you help me to screenshot your computer?
What do you want
Just
me to do?
you take a pictures of your computer.
1 minute. Just
Yeah.
give me a second.
Yeah.
Can you see me now on the other machine?
Yeah. Now I can see you. Okay, just 1 second.
Can you take a picture, because then I'll switch it off from here.
Yeah. Now it's okay, Professor. You can switch it off.
Okay. Thanks a lot.
Thank you.
right? The guy was speculating because he was lucky in that year. He became lucky because there was excess production. There was therefore a deposit. Therefore, there was a huge demand for the oil presses, and that is why he made money. That is how he made money. In the event the production was not that high, he probably would have lost money because the demand for the olive presses would not be that high. Can you see the PowerPoint now? Guys, can you, because somebody had said that you can't see the PowerPoint. Okay, so most of you can see. So I guess maybe Trung, you have a problem. So maybe you just might want to refresh the page. Okay, thank you. So this kind of gave him the right, and then that became one of the earliest known examples of derivative contracts. Much later, about 400 years back, you had this tulip options. These were done in Holland, in what is today's Netherlands. Dutch options on tulips, and you had these kind of contracts that came in. In the way we know of it, the first formal agricultural derivative contract came about in around 1859 when CBOT, or the Chicago Board of Trade, was set up, and they entered into the first set of agricultural derivatives contracts in a more structured, organized manner, much cruder than what we know of it today, but definitely in the structured manner. In some sense, the modern history of this kind of goes back to a much shorter period, about 50 years back, when in 1973, when the Chicago Board of Options Exchange was established, and which also coincided with what is known as the development of the Black-Scholes option pricing model that we will talk about later. Now, let me just skip this. This is some statements. You can skip that. What this shows you, okay, this is slightly old data, but what this shows you is, there are, and I'll talk about the two types of markets in a minute. There are two types of markets that exist in the world. This depends on the way trading happens. There is an OTC market, over-the-counter market, and there is an exchange-traded market. It is exchanges. What you have, so the color codes on both sides tell you what are the underlying products. So in the OTC market, if you can see, approximately 70% of the market is covered by interest rate and interest rate products. Equity covers a very small proportion. FX takes care of about 14%. So between foreign exchange and interest rate, it covers over close to 84% of the OTC market. Whereas when you go to the exchanges, you see equity, index, and stocks. Equity per se, overall, with equity being the underlying, covers about 62% of the market. And what this kind of indirectly shows me is that different markets have different products which are popular. Different types of markets have different types of products which are popular in their own space. Okay, let's skip this slide. You guys don't have to worry about this slide. Now, there's this thing of nature of the derivatives. So as I said, the first point is what I made, but then the question comes in, what are these underlying variables and what else? So obviously before I define that, as I said, each product will have one underlying associated with it. And the price of the derivative is predominantly determined by the price of this underlying variable, but not entirely. It also depends, amongst other things, on the underlying price of the underlying. Why do I say that? Because after all, think of it, the time to maturity, interest rate, These are some of the things that are also relevant in the pricing of the derivative. So while it does depend on, while there is a significant dependence on the price, on the value of the underlying, it also depends on other factors. And therefore the point I make out there, that the value of the derivative depends on, amongst other things, the value of the underlying. Now, what can be the underlying? The underlying can be anything. If you look at it, you can have physical commodities, and these are just some examples: coffee, crude oil, wheat, rice. Because what does it mean? It means that if I want to, I can physically deliver this asset. So if there is a need, these assets can be physically delivered to the counterparty as per the contract. So depending on the contractual arrangement, these can be physically delivered to the counterparty. That is what this physical commodities mean. Look at the next two, and there is a small difference, and you all should understand that difference. There is a financial asset, and there is a product on financial price. What is the difference? Why do you think I have financial asset and financial price separately out there? Any guess? Any guesses? Why do I have financial assets and financial prices separately? Anybody? Okay, I don't think anybody is attempting it. So let me only explain that. The difference is financial, what I've written as financial assets, it is the same as it is the same as physical commodities. Because if you look at that, currencies, stocks, bonds, these kinds of products can be physically delivered.
So at least I'm back out here. I don't know whether. Okay. Yeah, I'm back. Yeah. Okay. I'm back. So I mean, I don't know, somehow suddenly there was a internet issue and an internet drop happened. But anyway, so the commodity, the physical commodities, financial assets are what are called as real assets because they can be physically delivered. On the other hand, financial prices are something which cannot be physically delivered, and that is why they are what are known as referred to as notional assets. They are what are called as notional assets. These assets cannot be physically delivered, and hence, therefore, If you want to resolve, if you want to square off the position, if you want to close the position, you want to settle the position, you will have to settle it using cash. These are assets which are always going to be cash settled. So I can only give you the difference. So for example, if I said that the interest rate, so I said under the contract, at the end of the contract, you benefited by, let's say, 5% in the on the interest rate side. What does it mean to say 5% on the interest rate side? Is there a meaning to saying 5% on the interest rate side? The answer is, by itself, it has no meaning.
Professor,
can you hear me now?
Sorry, I think there's something wrong with your microphone, because we hear like your voice is not really like in the one line. It's like broken.
One second.
Oh, okay.
Good. Stupid. Stupid.
Is there anything like saying I'll give you 5% interest? The answer is no. There is nothing like saying I can give you 5% interest, because 5% interest means nothing unless you say it is 5% on a certain principle for a certain period of time, which means what? You are using a principal amount and a time to kind of monetize it and say, I will settle it in cash. Instead of giving you 5% interest, I will give you a certain amount of money, which is basically an outcome of applying the interest on the principal for that period. Realize if you change the principal or if you change the time, the amount of money will change, and therefore it is going to be dependent on the principal and the time to mature and the time that you're talking about. So that is what essentially mean. What do you mean by a financial price? That is also what is referred to as a notional asset. You cannot deliver a notional asset. There is nothing called delivery of a notional asset. You cannot deliver physically a notional asset. You can only settle a notional asset using other means. Cash is the most common means by which you can kind of deliver it. And that is what the difference between a financial asset and a financial price is. Financial assets, again, just for one more time, financial assets like physical commodities are nothing but real assets. Financial prices are what are referred to as notional assets. And notional assets will always have to be settled in cash. Whereas real assets, financial assets, physical commodities and all can be settled in both cash and asset. So real assets can be settled in either way. Financial assets can be only settled, financial prices notional assets can only be settled using cash. Is it fine now? One of you asked me, so did you get the difference now? Or you want me to tell you once again? Okay, good. Now, you could also have other kinds of derivative contracts. You could have it on, interest rates. Sorry, you could have it on weather. So how much will be the temperature rise by? How much will be the rainfall? What will be the amount of snow that could fall in a certain area? That any of these things could be an underlying that you can come in. Emission derivatives at some point was a very common product. It has lost its importance somewhat over the years, but it became a very common product. And again, it is emission derivatives are the classic example of financial engineering, as we would call it. What happened? You see, we all know now. Very recently, you had the COP26 in Glasgow. You had the famous COP21 in Paris a few years back. So that is basically the conference of parties on climate change that keeps on happening every year. Now, and every the governments come together, and increasingly there is this demand that emission is causing temperature rise across the world. There are a lot of greenhouse gases that are being emitted that are kind of eating into the atmospheric levels and other factors. So there should be a reduction in this amount of emission that is being made, and then there are country quotas that are set up with each country kind of saying that, okay, we will cut our emissions by a certain amount and things like that, right? So long back when it was started around 1994, one of the first treaties that came about was what was called as the Kyoto Protocol. And under the Kyoto Protocol, countries across the world were expected to reduce their greenhouse gas emissions. So they were kind of supposed to reduce their greenhouse gas emissions, and the amount of greenhouse gases at a point in time any country could emit. They came up with a formula to define that, to kind of come up with that. And that formula was fundamentally based on the size of the country, the population of the country, and level of development of the country. Now, the idea was that the better off the more developed countries like US, UK, countries in Western Europe and all of that, and maybe Japan and Australia, being up on the development index would kind of have lesser amount of so what they call as credits for emitting greenhouse gases, because they are already they were assumed to be developed, and therefore they could be kind of expected to do better, expected to have more advanced technologies, to kind of and then they had the money, they were rich, they had the money to spend to kind of do better and then reduce the greenhouse gas emission. Other countries, when you were a developing country, for example, countries like China, India, Brazil, well, they had big land masses, so they had scored on the land. They had huge population. India and China had huge population, so they kind of benefited from the population size, and their level of development was lower than the level of development of these Western European and some of these developed countries. What happened is, and therefore they got more, they got credits which was more than what, let's say, some of the other countries got. More than what they got, more than what other countries, what happened was they got credits more than what they were already emitting. And countries like the USA were already at the top of the limit. I mean, they were at least, they were on the kind of, they were already full of the, they kind of filled up the limit that they got. The idea was that countries like US and all, while they're at the top of the limit, they would also develop better strategies, better technology, so that things would get better. What they figured out in a sense, alternately, was there were other countries, as I said, China, India, Brazil, and a few other countries, which had excess credits. So what countries like USA and all did was, they simply went and bought these credits out. They bought these credits out from our countries like India, China, Brazil, and all, such that the total emission of greenhouse gases across the world remained constant, or probably marginally came down. But not by improving the quality and the standards and technology of the developed countries, but by using up the unused credit that other countries were kind of getting. Now, this obviously led to the introduction of a derivative market, and this market was doing very well for about 10 years. Till 2004, when in 2004, the US government unilaterally pulled out of the Kyoto Protocol. So basically, the US government said that we don't agree with all the conditions of the Kyoto Protocol, we are not going to follow it, and we are going to be on our own. The problem that happened then was, with the US gone out of the equation, US was the largest consumer, or the largest buyer in that market, because they bought most of the credits from other countries. So the largest buyer having gone out of the market meant that the market did not sustain long, and the market kind of collapsed, or the market kind of shrunk to a very small size. And today it's a much smaller market than what it used to be. It is again picking up with countries like Germany and the Scandinavian countries like Norway, Denmark, Finland, and all driving the market. But with the large player like US not there, it's still a very small shadow of what the market used to be earlier. And that market kind of there. You could also create derivatives on derivatives. So it's just not one contract, you could have multiple contracts. So you can have a layer on it's like multiple layers. One layer on top of the other and things like that. So I can create a multi-layered derivative contract as opposed to a single-layered simple derivative contract that could kind of be there. Now, as I said, and I had in an earlier slide, there are two types of markets that exist. And the two types of markets are exchange traded and OTC, or over the counter, as you can see. The two types of markets are exchange traded and OTC. What are the difference? The difference is that exchange traded are basically products or markets which are run on exchanges. So, like you have a Hanoi Stock Exchange, you have a Ho Chi Minh Stock Exchange, and these could also have derivative contracts. So if they're traded on an exchange, they are exchange traded products. Exchanges predominantly use Exchanges predominantly use electronic trading, and contracts are, and then therefore there is no physical trading that typically happens. Contracts are standardized; they are very, very standard contracts, and there is virtually zero credit risk. What do I mean by virtually zero credit risk? Basically, if there is a default, if by chance one of the counterparties default, the exchange then steps in and protects the other counterparty. What does the exchange do? The exchange then kind of steps in and makes sure that the other counterparty gets the money or gets the stock or whatever, typically money, and does not suffer a loss. The exchange uses mechanisms like margin accounts and all, and we'll talk about that to recover the loss from the defaulting counterparty. And in the process, if the exchange loses a little bit, well, that's what they have to live with. In terms of derivatives, the product, and I'm not talking about the products, which I will do in a second, but the products that are traded on an exchange are the futures contracts and options contracts. On the other hand, you have an OTC market. You have what is called as an OTC market. OTC markets are nothing but kind of a bilateral or a multilateral agreement or an understanding of the transaction. So you and I know each other, you and I do the transaction on our own. That is essentially what is an OTC market transaction. There is no standardized exchange, there is no standardized platform on which the transactions happen. It is a pure bilateral transaction. It could be multilateral also, that can happen. Typically, it is therefore a network of institutions, corporations, fund managers who kind of run this. Institutions often act as market makers, which is the help in kind of identifying and creating the market in the process. But the biggest thing is that contracts can be non-standard. So there doesn't have to be a standardized contract, and I'll just explain in a minute what do I mean by that. And most importantly, there will be credit risk, because in a sense there is no specific mechanism to protect the market, to protect individuals from protecting against each other, protecting against a potential default, and that is what is kind of will show up as a credit risk. Now, what do I mean by a standardization or non-standard contract? I mean, the opposite of that. You see, when you go to the exchange does transactions in fixed lot sizes. So, for example, you need a cover for, let's say, $1.79 million. The exchange does transactions in lot sizes of $500,000, which means to go for $1.79 million, you can either buy 3 contracts of $500,000 each, which will kind of get you a cover of 1.5 million, and leave the remaining amount of 0.29 million open, or buy a cover for 4 contracts, which will give you a cover for 2 million, and therefore you are overhedging yourself by 0.21 million. And this is happening because the exchange does not allow you to have a small broken contract and stuff like that. Right? On the other hand, in an OTC contract, you can go to a bank and you can specifically say, well, I want this amount of money, 1.79. What will be the transaction? What will be the rate? And what will be the cost that I will have to pay? So it can be specifically negotiated. While you might want 1.79, I might go and say, I want 1.37. Somebody else comes and says, I want 2.72. Each one of us have our own positions, own requirements, and they can all be kind of uniformly resolved at an individual level. In an organized exchange, that will not happen. I will actually have to take whatever is available and make do with that. Time is also another thing. All exchanges will have their contracts being settled on a given day, on a fixed day. Whereas in the context of OTC, you can define the exact date on which you want to do the settlement, on which you want to kind of let the option expire and things like that. Now, if you think of it, there are only two kinds of derivative contracts that exist. Everything else is essentially nothing but a trade-off or a combination of those. And the two types are the first two, forward-like contracts and option contracts. Anything else that is there is nothing but a combination of those contracts or of those frameworks. So your two basic contracts is a forward-like contract, which includes forward contracts, futures contracts, and we'll define them as we go along. And your alternate is an option contract, which can again be on a host of different things, and then that's it. Everything else, compound options, compound derivatives, structured products, exotic products, these are all combinations or trade-offs on these two basic products, which are your forward contracts and your option contracts. Everything else is nothing but a combination of those. I have already highlighted this. This is essentially, if you take the different kinds of contracts, what are traded where. So if you look at it, forward contracts are all I haven't defined forward contracts, but forward contracts are nothing but OTC contracts, over-the-counter contracts. Exchange traded, futures contracts are exchange traded contracts. In fact, one of the things that you also will see is a futures contract is nothing but a forward contract that trades on an exchange. And because it trades on an exchange, there are certain conditions that you have to follow. That's all. Futures contracts are nothing but forward contracts that are being traded on an exchange. Options, on the other hand, can be traded both on exchanges or on an OTC basis. Swaps, we'll talk about that right at the end. Swaps are nothing but essentially a series of forward contracts and non-overlapping adjacent forward contracts, and hence they are also OTC contracts by definition. Now, this is, and the first line is why we talk about derivatives. And in this context of this course, how are derivatives used? Well, derivatives are used to hedge. One of the primary usages of derivatives is to hedge price and other risks. So you realize that it is essentially a tool to hedge risks. It is essentially a tool to do risk management, which is where this kind of comes in. And that's that is the reason why we talk about derivatives out here. What you can, but understand one thing: if you could hedge using derivatives, you will also be able to speculate using derivatives. So a regulator will not want you to speculate, but a regulator would always want you to kind of manage your risks, to reduce your risks and things like that. So obviously, if you want to hedge, you also need to speculate. What do I mean by that? See, what I mean is that again, remember what I said yesterday. Risk management is not risk elimination, but risk redistribution, which means that I think it is risky. Somebody else thinks it's not risky, and the thing gets moved on to the other person. It is basically an outcome for the other person that the impact happens, because the other person is agreeable to take on the risk, right? Anybody who is agreeable to take on the risk now, you could also do something called arbitrage, and we'll talk about that. You could lock in arbitrage profit. You could kind of lock in the asset or the nature of you can lock in the profits that will get generated through an arbitrage possibility, and you can change the nature of liabilities or the nature of assets. The important question is, what is this thing about changing the nature of asset and liability? The important argument in that is you are changing the nature of asset or liability without exiting from the product. You could always say, why are you so worried? I mean, I will sell down. I have a loan on a fixed rate basis. I will sell it down and then borrow a fresh on floating rate basis. Or I will the other way around. I will sell down a floating rate loan and enter into a fixed rate basis. Well, you may not always be you may not always have the opportunity to exit and sell down from one side and enter on the other side. So you may not actually have the ability to do that at all points in time. And that is where the derivatives can kind of come into the picture. Now, let's define the different contracts that we were talking about. The first one that we have is what is called as a forward contract. And as you can see, the forward contract is an agreement to buy or sell an asset at a certain price in the future. So what is the thing that I do, and what is the uncertainty out here? I know the current price. I also know the time after which I will settle this. But I do not know what the expected price, what the price on that day would be. I have some idea based on current information and whatever else. I have some estimate of what that so I mean, it is essentially, I will kind of agree to buy or sell at a certain point in time in the future. And that because while I enter into the contract today and I settle the price at which I will buy or sell, so I have frozen the settlement price. The actual market price is still uncertain. And the market price will only be market price will evolve and only be known on the day of the maturity of the contract. And because that is unknown, the profit from this contract will also be unknown. Okay. Now, forward contracts are typically very popular on interest rates and currencies. They are not so popular on equity. Can it be done on equity? The answer is yes, it can be done on equity, but it is not as popular on equity as it is on some of the other things. So it is not necessarily it is not the way so different products prefer different things, and currencies and interest rates are something which are very popular to be used on forward contracts. What are some of the terminologies? So in a forward contract, if you have a long position, you're basically saying you're agreeing to buy the underlying asset at a certain specified future date for a certain specified future price. And the short position is agreeing to sell the asset on the same future date at the same price that you've agreed upon. The price that has been agreed upon is what is called as the delivery price, and the date on which the contract will be exercised is what is referred to as the exercise date or the settlement date. So this thing, and if you replace India by Vietnam, doesn't really matter. If you you are a treasurer of a company, and you would receive $1 million in 6 months' time. That is on March 31st, 2022, and you want to kind of protect yourself against any kind of exchange rate movement, because today you realize, as somebody told me earlier in the session, the exchange rate in Vietnam today is $1 is 23,000 VND. Now, on March 31st, how much can this be? So how much do you think it will be how much do you think will the USD value be on March 31st? You know, the current value, as somebody told me, was approximately 23,000. So how much do you think will it be on 31st of March in about 3 months' time? What do you think? Will it be 20? Will it be 25,000? Will it be 20,000? What do you think will it be? What is your expectation of the dollar against the VND in 2.5 months time from now? Yeah, so we may be up or down, right? So if today is 23,000, it could be 25,000 or it could be 20,000. Now here is the problem. The problem is if it is going up, it's fine. You don't worry, because you were earning 23,000 today. 2.5 months later, you will earn 25,000. So you are very happy about it. Nothing else has changed. But if it goes down to 20,000, you have a problem. Today you are earning 23. You will earn only 20,000 after 2.5 months for the same amount for $1, right? Now you were decided to do some project, or decided to do some investments or whatever, just because it was profitable. So just because it was profitable does not necessarily mean that it will continue to be profitable at 20,000. So just because it was profitable at 23,000 does not mean the project or the thing might be viable at 20,000. And therefore you would want to kind of protect yourself. So to prevent this uncertainty, what you are doing is you can undertake a currency forward with a bank today, under which you enter into a contract to sell $1 million 6 months from today, or when you're entering into an October 1, or you enter into an October 1, but essentially you enter into a contract to deliver $1 million on 31st of March, and there will be a particular rate that you will fix today. You may fix it at 23,000 itself. You may fix it at 24,000. So irrespective of what happens to the market, you will get that amount of money. So you give $1 for every dollar, you will get that amount of money. You have frozen that, you have fixed that. That is a typical example of a forward contract. So just to kind of give you an idea, I mean, again, this is based on rupees, and I did not obviously know the. Normally, I would have changed this to Vietnamese currency when I travel to Vietnam. But I have the bid and the offer price in the spot market. Remember, in a banking system, in a market system, what does it mean? Which means that if you want to sell, you can sell to the counterparty at the bid rate, and if you want to buy, you can buy. But irrespective of selling, you can buy it from the. So you have a bid and ask price, a bid and offer price. Similarly, for the forward price also, you will have a bid and offer price. So are you selling dollars? Are you buying dollars? If you are buying dollars, you will be the offer price will be applicable to you. The forward offer price will be applicable to you. If you are selling dollars, the forward bid price will be applicable to you. Now, therefore, if that is the case, if I were to look at how will the profits look like, these are what are the profits or the payoffs from a forward contract. So I have the two contracts. I can go long. I can be on a long contract, and the opposite of the long contract is the short contract. And as you can see, the diagram is exactly opposite to each other, right? Now, you basically, what are you saying? You are entering into a contract. So let's look at the long contract. You are entering into the contract to buy the asset in the future, whatever is the underlying asset, to buy the asset in the future at a price of K. Now, if the market is actually, if the value of the asset in the market is actually K, then on the maturity date, how much is your profit? You are buying it at K in the market. You have given somebody an idea. So essentially what will happen? You are buying at K If the price is exactly K on that day, your profit is 0. However, as the price increases, you realize that your profit keeps increasing because you can buy at K when the market has gone to a price higher than K. And therefore, but on the other hand, now this is where the thing happens, and this is important, because what happens out here is that you do not have the choice of saying, no, I will not exercise it. Because realize, when the price falls below K, when the price on maturity of the asset is below K, you're still having to buy it at K, you are making a loss. You could have bought it at the market price, which is less than K, but you are under the contract, you need to buy it at K. Therefore, you are suffering a loss in that process. And then that is feasible, or that is possible. Because what can happen is, in some cases, so therefore, you do not have a choice. You will have to exercise at K, and therefore you could actually make a loss. How much can be your loss? How much can be the maximum loss? The maximum loss, therefore, is minus K. Because what is the worst case thing that can happen? That an asset becomes worthless, the asset becomes useless, its value goes down to 0. But because you have a contractual agreement and all of that, you will still have to buy the asset at a price of K. So therefore, your loss could be as high as K. In practice, it may not be as high as K, it may be less than K, but your loss could be as high as K. What will be the payoff from the short option? So, in some sense, the benefit that you can get is that, again, you have been able to sell an asset whose market value is 0 at a price K, which means so obviously you can sell at an asset. So maximum profit you can make is therefore K, because you can sell a worthless asset at K. A worthless asset out here is taken to have a 0 value. Therefore, you are essentially saying you can sell a 0 value asset at a price of K, and therefore you can make the profit of K. So these are the payoff from forward contracts. The payoff from futures contracts is also identical. Simply why? Because simply for futures are nothing but forward contracts on an exchange. And they may have some exchange specifications on top of this, but the broad payoff will essentially be the same as this that you have. On the other hand, what is the futures contract? A futures contract is nothing but an agreement. Same thing. The first part is exactly like a forward contract. It is an agreement or an obligation to buy or sell an asset for a certain price at a certain time. So this is basically nothing but a forward contract traded on an exchange. Now, because you're trading a forward contract on an exchange, certain conditions of the exchange will apply, and hence futures contracts will be subject to those conditions of the exchange. If you take it as a forward contract, it will not, those conditions of the exchange do not apply. But given that a futures contract is obviously going to be traded on an exchange, it's the conditions of an exchange apply. But at the same time, the benefits that the exchange provides is also applicable out here. So basically, the virtually zero credit risk argument is applicable out here, because in the event the counterparty defaults, the exchange will step in and make good the loss and deal with the counterparty independently. Whereas if it was an OTC market, that might be now. Everything else is the same. It will obviously be traded on an exchange, as I said. What is a swap? One of the contracts is a swap. A swap is nothing but, the definition of a swap is an agreement to exchange cash flows at specified future times according to certain specified rules. So essentially, in some sense, it is nothing but a series of forward contracts each starting at different points in time and expiring at different points in time. So some of the examples of this are essentially interest rate swaps, currency swaps, etc. We will talk about swaps at a later point, but at this point I will just leave it with this to say that it is nothing but an agreement to exchange cash flows at specified future times under specified rules. Swaps are individually designed and hence they are necessarily OTC contracts. Swaps are not, the swaps are not contracts which are generally available generally tradable in the market, and hence they are not traded on the exchange. They are not exchange rate contracts. The other framework that you have is an option contract. And so before I do the option contract, let me just go back to this slide for a second, and then I'll come back to that slide. You see, this problem in the forward contract or the futures contract, whichever one you take, is the problem is that if why would you buy what do you think you would expect in the market that will prompt you to buy a long forward contract or go long with the forward contract? So what will be the problem? What is the change that you would want to do in a forward contract? If you had a choice, what will be the change that you would want to do in a forward contract? That is what you can do in an option contract. The change that you would want to do, and think of it, you would want to kind of ensure that the losses do not become that large. Because here, whatever is the size of K can be your maximum loss. So you do not want the losses to be very large if you have a choice. So what you say in an option contract is that I'm going to pay a premium upfront, and the losses will not exceed if the price in the market goes below the strike price, and we'll see that I will not exercise the contract. In the process, I will give up the premium or the price that I pay as a sunk cost. So whether I exercise the contract or not, that is kind of lost. So that is what essentially an option contract, the movement from a forward or a futures contract to an option contract is about. So an option contract gives you the right but not the obligation. The difference is that a forward contract or a futures contract, you are obligated to deliver on a future date. In an option contract, you have the right but not the obligation. So you do not have the obligation to deliver by a certain date for a certain obligation to exercise. However, what it gives you is the right to buy or sell. So if it's a call option, it gives you the right to buy. If it's a put option, it gives you the right to sell, and we'll just talk about it in a second. Whatever, a certain asset, buy by a certain date for a certain price. The price of the contract, the price of the contract is essentially the option price, but the price at which the contract, so there is I made a small typo out here. The price at which the contract is settled is the strike price or the exercise price. The price of the contract is still the option price, but at the price at which the contract is settled or the contract can be settled is what is referred to as the strike price or the exercise price. And the contract maturity date is what is defined as the expiration date or the maturity date. The contract is kind of the expiration date or the maturity date. Now there are two types of the options are divided are classified in various different manners. One classification is in the form of what is called as European or American options. As I've written out there, the term European or American does not have any bearing to the location of the option. A European option essentially is an option which will start which can only mature on a fixed date. So a European option can only be exercised on a fixed date. So there is only one day on which the option can be exercised. Even if you think the option is better, you can exercise the option early. Even if you think that there are possibilities of the option being exercised early and you can make money from it, a European option does not allow you to exercise early. On the other hand, the American option is such that it allows you to exercise at any point during the life of the option. So at any point during the life of the option, you can exercise an American option. You can exercise it only once. So it's basically saying it's like this. Let's say you have a friend of yours okay, let me give you an example to highlight the difference. A friend of yours gives you a invite. So, okay, a friend of yours invites you for dinner. Now, the European option would be the friend of yours says, let's have dinner on Sunday night at 7 p.m. or whatever. And then that becomes the, and therefore the invitation is valid only for the Sunday night, this Sunday night at 7 p.m. If you miss it on this Sunday, the dinner invite is not valid any longer. On the other hand, the American option equivalent is the friend says, okay, let's have dinner during the next week. You decide and tell me which day would be convenient for you to come have dinner with me. Which means that starting today till let's say next Sunday, let's say till next Sunday is what, 23rd. Till next Sunday, till the 23rd of January, you can decide on any one day on which you can have dinner with your friend. Not that you can have multiple, under this contract, you're not having multiple dinners. You can have dinner only once, but you do not have to do it only on a given date. You can choose the date between now and the final date. And you, whichever day you want, you can kind of choose it to have choose that. So you have a choice of when do you want to exercise the option. You can, as I said, you exercise it only once, but you have a choice of exercise at any point during the entire life of the contract. Whereas in a European option, you will only be able to exercise it on the last day of or on the maturity. You cannot, even if you think it is worthwhile for you to exercise early, you cannot exercise it early. That is where the difference is. Now, there is another way of defining, of differentiating this, and therefore I have these diagrams that show up out here. These are that is from what do you want to do. So you can, and that creates a little bit of a confusion. So just be a bit careful in listening to this. So I can have so I can have an option to buy an asset in the future. I can have an option to sell an asset in the future. So if you are a consumer, right, you believe let's say you are a consumer, you believe that the prices will rise in the future. So what kind of a protection would you want? You would want to buy a call option, because that would allow you to buy the asset at a prefixed price in the future if the market goes above it. If the market is below it, you can then buy it at the market price. There is a premium that you kind of lose as the sunk cost. Right? Now, in as much as that you can buy at a certain price, if you are a producer, so if you are a farmer, for example, if you are a coffee grower, what is your fear? Or if you're a rice grower, if you're a rice farmer, what is your fear? Your fear is that the price of rice or the price of coffee will fall below a certain level at which it will not be worthwhile for you to sell. I mean, you will not recover your costs. So then you would want to have an option to sell the rice at a certain price or coffee at a certain price if the market price is below that. If the market price is above that, you will have no incentive to sell it at that price and you will not sell it. You will let it expire in worth, you will let it expire in the worth market, expire worthless and lose the premium. So the right to sell is what is referred to as the put option. So the call option gives you the right to buy, the put option gives you the right to sell. Now, realize one thing, and this is where the additional confusion happens, and that is, if I buy the, now, if I have the right to buy the, so now let's look at the first part, right to buy the asset. If I have the right to buy the, if I want to retain the right to buy the asset, which means what? I buy the call option. The moment I buy the call option, somebody has to sell the call option to me, right? If I, like in anything else, if I buy an asset, somebody has to sell an asset to me. So the moment I buy a call option, somebody has to sell the call option to me. To differentiate this, and I buy, so the other condition is the person who buys the contract pays the premium, whatever is the premium. So if I buy a call option, which means the person who sells the call option will sell it to me at K when the market price goes above K, and in return has earned the so you actually have a buyer of the contract. So you have, so therefore you have four scenarios. You have a buyer of the asset, you have a seller of the asset, and then you have a buyer of the contract, you have a seller of the contract. The first, how do you differentiate? Remember I said for an option contract, to retain the right, you have to pay the premium. The person who pays the premium is the buyer of the contract. The person who pays the premium is essentially the buyer of the contract, and therefore retains the right to exercise it at a future point in time. Right? So the person who pays the premium is the buyer of the contract, and the buyer of the contract is the person who retains the right to decide what to do. The person who sells the contract is the person who receives the premium. The person who receives the premium does not have the choice of deciding whether to exercise or not. That choice is exercised by that choice is kind of exercised by the person who has paid the premium. So the person who has received the premium does not have a choice, and therefore, as you can see out here, the maximum loss that the buyer of the contract can make is essentially nothing but the premium of the contract. The maximum loss that the maximum profit that the writer of the contract can make is the premium of the contract again. The maximum loss that the writer of the contract can make is infinite, in as much as the maximum profit that the buyer of the contract can make. Now, why am I saying this? So first, look at the buyer of the call, and then we'll go to the buyer of the put also. Now, let's take some numbers, right? Let's say K strike price is 100. Let's say K is 100. Let's say the premium is 10. So K plus P, K plus the premium is 110. So I'm saying that the price is 100. And I'm saying, sorry, the strike price, the right price at which I can buy is 100. And the premium is 10. Now, I do not know what the option price will be on maturity. I'm saying I'm dividing the option price into three possible zones. Below 100, between 100 to 110, and above 110. Now, I do not know what the option price will be, but I can always say that the option price will be in one of these three zones: below 100, between 100 to 110, above 110. There can be no other place where the option price can be, sorry, the underlying asset price can be. Now, if the asset price is more than 110, and you can buy it at a price of 100 today, plus 10 that you've paid earlier as premium. So the net cost you are paying is therefore 110. If you can buy the asset at a price of 110 net, when the market price is higher than that, you will always be happy about it. price is above 110, you will always exercise the contract. How much more can the price go above 110? Any number, you don't know, right? And therefore, the profit will keep on increasing. If it goes to 140, your profit is 30. If it goes to 200, your profit is 90. If it goes to 1000, your profit is 100, so 890. So it will keep on increasing depending on how much the price goes up to. Okay, so that's one segment. If the price is below 100, let's take the price is below 100, what happens? So let's assume that the price is 99. The price is below 100. Let me assume the price is 99. What happens if you buy it in the contract? You will still have to pay 110. On the other hand, if you do not buy it in the contract, you will pay 99 in the market and you have already paid 10 as a sunk cost premium. So your net cost becomes 109. Now, given that 109 is obviously less than 110, you will never exercise the contract. And the lower the price goes, the bigger is this gap, and therefore the possibility of you exercising does not come in. So if the price in the call option, if the price is below the strike price, you will never exercise the call option. If the price is above the if below the strike price, you will never exercise the call option. What we have shown is if it is above the strike price plus the premium, you will exercise. But what happens between 100 and 110? Let's assume that the price between 100 and 110, some value, let's say 104. Now, to buy it in the contract, your net price will be 110. If you do, but 104 is less than 110, why would you want to pay 110 when the market price is only 104, right? But realize if you do not, now if you want to buy it at 104, and don't want to exercise the contract and you want to buy it outside, what will happen? You will pay 104 to buy the asset. You've already paid 10 as premium, so your net cost will become 114. So effectively, your price then becomes 114 in one case. So in another case, you're going to pay 110. So in one case, your loss relative to the market price is 6. In the other case, your loss is 10. Now, yes, profit maximization is your primary objective. However, if profit maximization cannot be achieved, loss minimization is your next best alternative. So therefore, what happens is that the moment the price crosses the strike price, you will exercise it. So you have in a call option, if for the holder of a call option, the holder, remember, is the person who's bought it and who's paid the premium. The condition is very, very simple. The moment the price crosses the strike price, you will exercise it. If it does not cross the strike price, if it is below the strike price, you will not exercise it. And that kind of brings down to another definition. So if by exercise of the contract, I am going to make money, it is what is called as in the money option. If by exercise of the option, I will not make money, I will lose, it is called OTM or out of the money option. If the contract is such, if the price is such that I neither make a profit nor make a loss, in other words, ST is equal to X, then I get what is called as the at the money option. So effectively, if ST is in a call option scenario, if ST is greater than X, the option is in the money. If ST, here it's K. If ST is greater than K, here it's in the money. If ST is equal to K, it is at the money. If ST is less than K, it is out of the money. Now please realize that all of this that I talked about is valid and true for the option holder or the person who has bought the option, paid the premium. Now the best case scenario, now for the person who's received the premium, the best case scenario is the person has bought the option but does not exercise it. And therefore, the person who has sold the option continues to earn the premium as a profit. There is no adjustment against the premium. However, once the option is exercised by the option holder, that has to be necessarily exercised in the spot market also. Right? So obviously, in the context of the writer of the option, you see that the maximum premium is the maximum income is the premium. The option is not exercised, and therefore the premium being the sunk cost is what is earned by the option writer. If the option is exercised, in as much as the profit of the option holder is profit, in a call option, the profit of the option holder is infinite. Therefore, the loss of the option writer can also be infinite. So this downside risk protection that is talked about, so as options are said to offer downside risk protection, is valid only for the holder or the buyer of the option, not the writer of the option. Right? In fact, the formal statement is the writer of the option is obligated. The writer of an option is obligated to exercise the option if the holder of the option so decides. So that is what it kind of brings in. Now, the other thing that also happens is the question of the put option. What is the put option? The put option gives you the right to sell. The put option gives the holder the right to sell. Who would want a put option? You would want a put option if you had an asset that you wanted to sell. If you have an asset you want to sell, you would definitely want a put option. Because if you are a farmer, for example, you would want to ensure that you earn a minimum price for your produce. So that is what your strike price out here. So what happens is, if the market price goes above the strike price, you don't exercise it, and that you had the, so you do not exercise it. You will obviously exercise it in the market. If the asset price falls below the strike price, you will always exercise it in the contract, because you will get better returns in the process. So you will exercise it if it falls below the strike price. Now the same logic holds if it falls below the strike price. Sorry, if it goes above the strike price, do not exercise. If it falls below the strike price, always exercise. The only thing that you have to remember out here, that your break even does not happen at K plus the premium, but happens at K minus the premium. Because you are paying the premium upfront, on exercise you will earn K. Therefore, your net value that you will earn is strike price minus the premium paid. And that is why, if you see on the left hand side, it is still loss making till it goes below K minus the premium paid, and then you start making profits. Now, similar to the call option, the writer of the put option also has the fixed upside, which is the premium, and has a large downside, because the downside can also be because the downside is defined by what is the upside for the option holder. The question that I have, and let's see what you have to say, and please look at this. See, in the previous slide, in the call option slide, the loss for the call option, writer of the call option, is infinite, is an infinite loss. What is the loss? What is the maximum loss for the writer of a put option? The writer of a call option has a maximum loss of infinity, or a very infinitely large loss. What is the maximum loss that the writer of the put option has? What is the maximum loss that the writer of the put option can have? What do you think? So in other words, how low can this line go? So if I go back again to show you, in the previous slide, this line can keep on increasing, and the larger it goes to infinity. When it comes here, how low can this price go? It goes low. There's a large loss that can happen, and all that is fine. question I have is how low, what is the maximum loss that the writer of the put option can be exposed to? What is the maximum loss that the writer of the put option is exposed to? Premium. No, that premium is with the holder or the buyer of the option. The seller, writer is the seller of the option. So you're right with the premium when it comes to this side, which is for the buyer of the option. I'm talking about the writer or the seller. The question is it unlimited? Fam, the question is, please think that in this case it is unlimited. Premium for long put, I'm not talking about the premium for the long put. What is the loss for the short put position? The loss for the short call is infinity. Is the loss for the short put also infinity? Please think about it a little bit. The loss for the maximum loss for the short call position is infinity, no problem. Is the loss for the short put position also infinity? Exactly. Now you get it, fam. It is not infinity. The maximum loss that a short put can get is the entire value of the stock, because the stock value cannot go below zero. Remember, can the stock value go below zero? Can the stock value be negative? The answer is no. So if the stock value cannot go zero, therefore the lowest value the asset price can go to is zero, right? So the maximum loss for the put option, the writer of the put option, is the entire value of the stock itself, because the stock price cannot become negative. Whereas the loss for the writer of the call option can be infinite, because the maximum value of the asset can be plus infinity, and therefore the loss can be minus infinity on the other side. That is important, because in both cases the losses are large, but on the comparative, as a comparison between the two, the maximum loss for the writer of the call option will be larger than the maximum loss for the writer of the put option. Okay. Now you could also divide the market in terms of this set, which is basically the types of traders. There are three kinds of traders that you can kind of get in the market. We have generally spoken about the first two, hedgers and therefore speculators. But you also have a third set of players, which is basically arbitrageurs. What is it? And if you look at it, hedgers are people who are not essentially they are essentially spot market players. They are interested in buying or selling to reduce their risk, that they already face through using derivative contracts. Now, forward contracts, option contracts, futures contracts are all designed to kind of ensure that you can kind of reduce your risk by buying or by trading on them. So that is the argument of a hedger. On the other hand, there is a set of players or set of participants in the market who are referred to as the speculators. Now, the speculators are players who would want to take a position in the market by betting that it will either go up or go down. So they are the risk takers. Again, futures, options, forwards can all be used as tools for speculation and therefore used in this context as an underlying product. So as I said, when the speculator uses a futures contract to speculate, the potential gain or loss is high, because in that the entire line is there. You could earn a very high profit. You could also lose a lot of money. On the other hand, if you use options, The speculator's loss is limited, as some of you have been saying earlier, your loss is limited to the premium that you are paying, not an infinite loss, right? The point is that the market cannot survive without hedgers and speculators. At all points, both hedgers and speculators have to be in the market. Otherwise, there will be no market transaction. Somebody sells because they want to so somebody wants to protect and somebody is ready to take the risk. Both of them need to be there in the market for the market to survive. An arbitrager does not need to be there in the market for the market to survive. An arbitrager may be there, but an arbitrager does not need to be there in the market for the market to survive. Arbitrage is basically a riskless profit. We spoke about it earlier as well. Arbitrage is nothing but a riskless profit. What you land up doing is that you're simultaneously entering into transactions so that you can lock in the profit from different markets, different trades, and then you can kind of, that is a riskless profit. So look at this example that I have out there. Let's say a stock is traded both in New York and London. The price in London is the price in New York is $172 and the price in London is 100 pounds, 100 sterling, right? Also, the exchange rate market shows 1 pound is equal to $1.75. Now, what does this imply? And then this is where the mismatch is happening. What is happening? You see, if I take the exchange rate, the currency market tells me the exchange rate is $1. Sorry, 1 pound is $1.75. Very good. If I look at the implied exchange rate coming from the stock price, the implied exchange rate is so if you look at this, you have an exchange rate which comes from 1.72 on one side and the other side the exchange rate is 1.75. Do we know which is correct? So how can you make a profit? The way you can make a profit is kind of given out there. I simultaneously buy 100 shares of the stock in New York and sell them in London. So what happens? I will buy at 1.175. So by buying at 100 shares in New York, I'm paying $172 per share. And I'm selling that in London, I'm earning 100 pounds and the exchange rate is 1.75. So 1.75 into 100, which is how I get $175. So by selling it in New York, London and recovering the exchange rate, I get $175. I buy a share for $172. Therefore, I make $3 as profit into 100 shares. Therefore, I make $300 as profit. Obviously, no transaction cost and all that. But the question that remains, the question that I think one needs to ask is, which is the correct price? Is 172 the correct price? Is 175 the correct price? And I do not know. The problem is that I do not know which is the correct price. If at all any one of this is the correct price, it could be anything. And that is what. But one of this is going but both of this cannot survive, because if it happens, then people will use this opportunity to make riskless profits. So what happens? So one of the conditions of arbitrage is arbitrage exists only if markets have inefficiencies. So there will be no arbitrage in a perfect market. It is only in an imperfect market that arbitrage does exist. The second thing is, the first player has the advantage or makes the arbitrage profit. Subsequently, there is no further arbitrage profit that will happen. Why? Because the first time this is happening, I do not know. Somebody else has spotted it and therefore makes money out of it. Very good. However, having said that, so I do not know which one of the two is going to be correct, and only the first guy will get this benefit. The moment I get this benefit, in as much as I make the $3 profit per share, the person who loses also gets to know that there is a $3 profit that somebody else is making, which means what will happen? The prices will readjust itself. I do not know whether the price will go to 175 or the price will go to 172, or both will happen, in the sense the price in New York will go up a little bit, the price in the exchange rate in 1.75 will go down a little bit, 1.72 the implied rate may go up a little bit. So both may happen such that you come to a midpoint where it stabilizes. But what will happen is that this will not be able to be continued for a very long period of time, because as I said, after the first guy has made the money, the subsequent people will not have the ability to make money because this inefficiency or anomaly has been identified, and therefore people would have resolved that, people would have squared that position off. Okay. Yeah. So what I've done out here for the first time this year, I've tried to put a few problems just to explain and help you all understand it a little better than purely just listening to me, because normally if I was in the classroom I would have done it on the board. Since I'm not there, I thought I will put in a few slides with a few problems, and then that might be easier for you to kind of relate to. So look at this. You enter into a contract to sell 100,000 British pounds for US dollars at an exchange rate of 1.9000 US dollars per pound. How much would you gain or lose if the exchange rate is at the end goes to 1.8900 and 1.9200? Two different examples. So in the first place, what happens? You sell 100,000 British pounds for 1.99000 US dollars per pound. Exchange rate is, when the exchange rate is 1.8900 US dollars per pound. So how much is the gain? The gain is 100,000 into the difference, which is $1,000. How much is the loss on the other side? By the same logic, you are selling it at 1.92. Sorry, you are selling it at 1.9, whereas you could have sold it at 1.92. So the loss per period is 1.92 in minus 1.9000. Okay. So you can easily see that the price, that's the benefit that you make. What about this? You would like to speculate on the rise of price of a certain stock. The current stock price is 29. The 3-month call with a strike price of $30 costs you $2.90 today. You have $5,800 to invest. What are the strategies that you can look at such that in one involving the investment in the stock and the other involving investment in the option? And in each case, what are the potential profits or losses, gains or losses? First case, it is only stock. The second case, it is option. So if you look at it in the first case, what can you do? Your current stock price is 29. Your total money is 5,800. So therefore, you can buy 5,800 divided by 29, therefore 200 shares. In the second case, the option premium is 2.9. You have 5,800. So I can buy 5,800 divided by 2.9. Therefore, that is how I can get 2,000 options. Now, if what happens is, if the share price does well, if the share price goes up, the second strategy of buying 2,000 options will kind of give me a much better gain. If the share price does not go up, the share price goes down. So if the share price does badly, strategy 2 will give a greater loss as well. So if the market does well, strategy 2, which is buying 2,000 options, gives you why does that happen? This is why it happens. Oh, sorry. the reason it happens, I've not explained that out here. The reason it happens is because you see, if the price goes up or by this, whatever the price goes up, that is what happens. Here, if the price goes up, you will exercise it and you will buy it at 30. If the price goes to 40, you are still buying it at 30. If the price goes to, so you can buy 2,000 shares at 30 when the market price is 40, which means you are making a profit of $10 into 2,000 shares. So you are making 20,000 as the profit. However, if the asset price goes down, what happens? You let the option expire worthless. How much do you lose? The maximum loss that you can have is essentially you don't exercise it at all. You lose the entire amount of the premium. Right? In the case of buying the stock, the same thing happens. How much can you lose? The maximum amount is losses. Asset value goes to 0. So you lose the entire 5,800. If the asset price does not go to 0, if the asset price increases, you make that additional amount as profit. So I have this another example. I spot current price is this. The price after 90 days is expected, the forward price is expected to be this. After 180 days, it's expected to be this. What kind of opportunities are open to the arbitrager in these scenarios? So in the first case, I have a 180-day of European call option. I can buy that for £1 to buy £1 for $1.97, and that costs me 2 cents. The second one is a 90-day European put option to sell £1 for 2.04, costs me 2 cents. How can I solve? What kind of arbitrage opportunities? So let's look at the first one. The trader buys, in the first case, 180-day European call option. So the trader buys a 180-day European call option and takes a short position in the 180-day forward contract. Let ST be the terminal price. How much is the profit for the call option? Remember, he has bought it to buy dollars, to exchange it at 1.97. So if the price goes above 1.97, he profits. So the profit from the call option is the maximum of ST minus 1.97 and 0, and then you take out the cost that you've paid. You've paid 0.2 cents or $0.02 to buy it, so that is kind of reduced, and that becomes the maximum the profit from the call option. What is the profit from the short forward contract? Remember the 2-month, 180 days 2.0018. So you have the right to sell it at 2.0018 less minus ST. That becomes your profit, because if ST is less than that, that is where you're making the profit. So the profit from the strategy is just add all of it up. And if you add all of it up, what do you get? Max, if you solve it, max of ST minus 1.970 plus 1.9818 minus right. So therefore, the profit is, now if you solve that, maximum ST minus 1.97 and 0 plus 1.9818 minus ST. So this is, so when the price is less than 1.97, your profit is 1.9818 minus ST. When and 0.11 and because when it is greater than 1.97, you will buy it at 1.97, but you also have 1.98. So essentially it becomes nothing but the difference of the two, which is 0.000118 when it is greater than 1.97. So irrespective of what happens, you see, you always get a positive outcome. You get a profit, and therefore it is basically therefore this shows that this becomes nothing but it is always positive, and therefore it is an arbitrage possibility. The last one, the other one is the same thing. You do it the other way around. The profit from the put option is you are able to sell it at the strike price. So how much the benefit is when you sell it at the benefit maximum of the price at which you sell less the fixed price less the market price, that is your profit. So again, that is max of the strike price minus ST at 0 minus the premium that you already paid. How much is the profit from the long contract? You will be able to buy it at ST. Sorry, you'll be able to sell it at ST when the in excess of when you're making a profit in excess of when the price is in excess of that amount 2.0056. So the difference is your profit. So the total profit from the contract from the entire product is the sum of these two profits. If you add it up again in the same manner and expand that out, you just take care of the 0.02 and you solve it. So this shows that ST minus, right? So this shows that the profit from the strategy is the sum of this, and if you simplify that, that becomes that. Now, if the price is greater than 2.04, you will always earn ST minus 2.02. The first term will go to 0, so you will only earn ST minus 2.0256. ST being greater than 2.04, this will always be positive. When ST is less than 2.04, what will happen? The first term will actually vanish. So therefore, again, whatever you do, you'll always get a profit, which is always positive. And hence, this also gets you a this also kind of gets you a positive profit and an arbitrage possibility under all conditions. I have got a few more examples. You can read through them and and I have solved them also. It is not that I have not solved them. I have solved each one of them and I explained each one of them. So you will be able to understand. And for the want of time, I cannot go through each one of them. But there are two additional examples that I have done out here. Please try to go through them. They are solved. Problem 4 and problem 5, the answers are here. Please go through them. And if you still have a problem, we will kind of discuss that subsequently. But at this point, I would leave it there by saying the solutions are there. Please do look at that and please do kind of work it out to see that you understand the solution that I have put there. Okay. Okay. Any questions? Slide 11. Okay. Good. Okay. 1 minute. I'll go to slide 11. Yeah. So what is the question? How are derivatives used? And I'll give an example. Okay. So this is where the swap comes in, and you will understand this a little better later. But since you're asking me the question, I'll put it this way. Let's say you've given a loan. You're a bank. You've given a loan to somebody else. You've given a loan, right? Now you do not, for whatever reason, you do not want to have the loan on your books. What can you do? You can ask the borrower to repay and say, okay, I will close out the loan. That's the easy part. But maybe you are not in a position to do that because there are other covenants, there are other legal constraints which does not allow you to call back the loan early. You go and find out another player in the market who is ready to take that exposure, who is ready to kind of say, okay, I don't mind giving a loan to this guy. You are not able to sell. You are not able to transfer the loan. What do? You enter into a transaction with this guy and say, okay, you give me the present value of the loan. On the other hand, when the loan repayments happen, I will pass it on to the third party. So there is a loan between you and the and a borrower, and there is another player A. You say A is ready to take on the loan, but you cannot sell the loan to A because of other regulatory and legal constraints. So what you do is you enter into a contract, you enter into a product, a swap product, by which you say, okay, as we go forward, every time the borrower makes a payment on the loan to me, I will transfer this to party A. In return, A gives me a cash amount today, which is the present value of all the payments that he or she is expected to earn from this player. That way, I had a liability or I had an asset. I have changed the nature of it. I have got rid of the liability. I've probably converted it into an asset or whatever. I have got the cash, but I have not really exited from the product. So that is a simple example of a swap transaction where I have changed the nature of my liability, and I can also change the nature of my asset. So if I can change the nature of my asset, I can also change the nature of liability, and I have basically done that to change the whole position from my perspective. Okay. 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 Any other questions on these slides? Okay. Sorry, I took a little longer, and I'm sorry in between for the the confusion. I don't know what happened, but hopefully we've resolved it. Let's take a break. I know we've overshot a lot of time to take a break. So let's take a break. It's what? It's about 4:30, 4:20 for you, right? 20 minutes past 4. So let's take a break, and we will join back at 4:30, 4:35, so that we can finish by 5 o'clock. Okay? Let's take a quick 15-minute break, and we'll start off with the next set of slides, and we will start off at 4:35 your time. So the next thing that we move on to is the slide on mechanics of futures markets. You again have the slide, so there is really no problem, but I'm just kind of telling you this is the next thing that we move on to. Okay. So what is this? This is, you don't have to worry about this. For those of you who want that, there are, so I have not written down or I have not copied the exact specifications of each contract, the CME contract, and then India is a very large player in the futures market. Therefore, Nifty futures on NSE, the National Stock Exchange of India. So these are futures contracts, and if you go there, if you get into, if you click on these, this links, you can get the details of the contract. I mean, as the exchanges trade on it. This is more for information, nothing more than that. Okay. No. Okay. Again, these are some examples. You can skip this slide. This is with specific reference to India because I could kind of find that. The real argument starts from here in terms of futures contracts. So, like a forward contract, it is an agreement between two counterparties to exchange one asset for another at a specified date in the future. So, the other things is that contract conditions are fixed upfront. However, there are a number of significant differences. And these differences come in with respect to the contractual features, the market organization, the kind of participants in the market, and how does the profile of gains and losses come up on a daily basis. That's something that we will actually talk about. So what are the major features of a futures contract? The primary argument, of the most important point is that this is traded on organized exchanges and it is not an OTC contract. So these are traded on organized exchanges and not OTC. There is a standardization that has to be there, which is how much is the asset. So like, what is the size of the contract, amount of asset, when does the contract expire? Not on a day you and I want, but the exchange has pre-specified dates. Last day of the month, last Friday of the month, whatever it is. But I cannot, even if I want, I cannot close the contract on any other day and things like that. It is on that day itself. What are the deliverable grades? Deliverable grades comes in primarily from an agricultural contract, because if you, let's say you enter into a contract at the time when the, let's say, rice was being sown, and the rice will be harvested after 4 months or something like that. Now, even if you control for everything, the quality of the rice that is harvested is not always constant. And therefore, what do you deliver vis-a-vis what have you promised? So therefore, and if that is the case, there might be some adjustment that is needed, which is essentially the whole argument of deliverable grades. And if I have to give you a different quality of product, then how do I adjust for that? Because if there is a better quality of product, how much will the price adjustment be? If it's a worse kind of a product, how much will the price adjustment be? And how much better and how much worse is acceptable in the bank is something that the exchanges will have to pre-specify. Now, in an exchange contract, there is always got, and I'll show you this thing. There is a clearinghouse, and there is a chart that will come up in terms of the clearinghouse. There is a clearinghouse which is kind of a party to all contracts, and they are the ones who kind of guarantee the performance. It guarantees performance of the contract. Exchanges also ensure that the credit risk is eliminated, or even if it is not eliminated, it is significantly reduced. And how does it do that? It does it through the margin account and the margin balancing, and that I'll show you. And one of the things it does is an important argument called marking to market. Mark to market or marking to market. Now it is done on a daily basis, and that is why it's called daily settlement of gains or losses. What is marking to market? Mark to market? Marking to market or mark to market is the fact that there are, you have a contract. So I'll give you a different example, and then you should be able to understand what mark to market is. So let's say you have bought an apartment, you stay in an apartment, right? You've bought an apartment and you stay in an apartment. Now I ask you, what is the value of your apartment? How do you find out the value of your apartment? Well, the true value of your apartment is the amount that you will earn if you were to sell the apartment in the market. That is the actual true worth of your apartment. But you're staying in the apartment. How will you sell it? And then where do you stay? So the idea is that if I were to think about selling it, how much do you think I will earn in the market? I'm not selling it. If I were to sell it, how much would be the income that I would generate? That becomes a mark-to-market value of the contract, of the asset. And therefore, it is not an actual sell down or actual closure of the contract. It is an expectation of the sell down or closure of the contract on a hypothetical basis. If you were to do it, how much would be your profit? How much would be your loss? That is what the mark-to-market valuation is. In a futures contract, though a lot of these are real assets, as we said earlier, you can actually settle them physically, but in practice, actual delivery is very, very rare. In most cases, it is kind of cash settled, and it is used predominantly for hedging or speculation, not so much to acquire the underlying asset. It is not so much designed towards buying the underlying asset physically as like it is designed towards hedging or speculation. Now, what are the specifications of the futures contract? These are the specifications. What is the asset? What is the size of the contract? What are the delivery arrangements? Are you going to settle in cash? Are you going to give it physically? What are the delivery arrangements? What are the prices, the price codes, the price limits, and the position limits? And all of this kind of come in defining the size of the contract, the contract itself. So what is the specification of the assets? Now, financial assets are kind of fairly simple in futures contracts because they're very well defined and no additional specification needs to be done. So bonds, currencies, and all are kind of very easily understood and taken care of. However, in the context of commodities, as I said, that is where a variation in quality is what might be available in the market. And therefore, you actually have to define what are the acceptable grades. As I said, rice, there might be various different grades of rice. What are the grades that are acceptable in this contract? That has to be defined. In some cases, a range of grades can be delivered, but the price received will have to be a function of the price received will be a function of the grades chosen. In that case, the price is adjusted in a way that is established by the exchange. So there's really no problem with that. So the next thing is, what is the contract size? So forget the thing below, but the point is that's just an example. The point is, if the contract size is very large, the small investors will be unable to use it because so if I said the contract size is like $5 million, how many small investors do you think will be able to access a minimum contract of $5 million? So obviously the contract, and that is why the contract size becomes important. If the contract size is very large, you will not be able to use they will be thrown out of the exchange because they will not be able to access the exchange. On the other hand, if the contract size is too small, large players will not want to come in because trading becomes very expensive. Every trade will require a trading cost. There is a transaction cost and all of that, and that will kind of prevent large players from coming in. So the problem is you can't have huge contract sizes. You can't have too small contract sizes as well. A lot of exchanges therefore have differentiated. They have the regular contracts on the main exchange. They have also created a so-called mini exchange or mini contracts to attract the small investors. The last one is basically, that's the example, but forget that. That's a specific example that I've picked up from the contract in India. But essentially, the idea is that if the contract size is very large, small investors will not be able to come in. If the contract size is very small, then while small investors can come in, but the large investors who want to buy large volumes will find it difficult to come in because the transaction costs will become very high, and they would actually have to adjust it in that fashion. So then they would not want to come in, and that because for them it becomes unviable. Which is why a lot of exchanges have introduced regular contracts, mini contracts targeting different investors. The other thing, as I said, is this is also there that the delivery place has to be kind of specified by the exchange, because after all, delivery could involve significant transportation costs. In the case of alternative delivery locations, the price that you get, the price that is received by the short holder is adjusted according to the location chosen by the delivery. Because if I'm sitting in, so for example, if I'm an oil buyer in New York and you give me an oil somewhere in Malaysia, there's a huge because you have a go down to keep the oil there. The transportation cost becomes huge. Whereas as compared to somebody who gets oil from, let's say, the United States itself. So to offset that, there will be price adjustments that will actually be done. Now, as I said, in financial futures, delivery is very rare, and therefore that does not really matter. In non-financial futures, in assets, non-financial assets, delivery might still happen. And most traders will choose and the delivery might should happen. But as I said, in financial futures, it is basically cash settled. So effectively, even though it could be physically settled, the traders will kind of choose to close out the position, which is pay the difference of profit or loss and close out the position and not really do a delivery. You also have price limits and position limits. The price limits are put in place in most cases to prevent large market movements, which could happen because of speculation. So to prevent speculation or to control for speculation, you have price limits. And when the price limits kind of move very fast, the exchanges also readjust the limits because the exchanges are also working on a real-time basis. The position limits is also the same, a risk management process. Basically, it is the maximum number of contracts that a speculator may actually hold. This is ensured to ensure that there is a larger set of players that right. So both price limits and position limits are put in to ensure that the market movements are kind of stable. So the price limits are to ensure that the speculation is reduced, and the position limit is put in to ensure there is no concentration risk. So there's no one person who's buying everything and therefore can have a concentration risk. So that is the and therefore, because if there is one person who has a very large position and has a concentration thing, one is obviously the risk that person faces. The other is if this is something which is in demand in the market, because there is only one, because there is a large player who's controlling the market. Now, what does a closing out position mean? It basically means entering into a contract from the opposite side of the trade or opposite trade as to the original contract. So basically, if you have a long position, for example, if you have a long position in August cotton futures, you can close out the position anytime before August by selling the same contract on cotton. So what will happen? The price at which you bought the contract and the price at which you are selling will be different. The difference will be the total gain or loss is the difference in the August cotton future price between the start day and the closing out day. So that is what will be your profit or loss. But what happens is that both the contracts are maturing on the same day. In one case you are buying, in the other case you are selling, and therefore your net position essentially from that perspective goes to zero. You only earn the premium that you have. I mean the difference between the start and the end values. Now this is also there, which is kind of which kind of works, which is you could have the futures price lead the spot price, or in a different scenario, you could have the spot price lead the futures price. We do not know what will happen, which one will happen. But what we know for a fact is that one of these two will happen. And this can change at different points in time. So right now, you could have a scenario in the market that for a given contract, the futures leads the spot. At a later point, it could revert and kind of become the spot leading the futures also. Now, there are two types of margins that are collected with a member from the trader. One is called two types of margins. One is called the trading margin. This is what is collected by a member from the trader. And then there is a clearing margin, that is the exchange collected from the member. But before that, what is the margin? Okay, I'll talk about that. And why is the margin coming? Margin is a cash or marketable securities deposited by an investor with his or her broker. The daily balance in the margin account is adjusted to reflect the daily settlement. Why are margins brought in? Margins minimize the possibility of a loss through default on a contract. So margins kind of help in minimizing the losses. Now, how does it work? I think I have the slide there. No? Just one second. Okay, no, I do not have that. So let me. I thought I had that slide, but then I will. Yeah. So what is a margin? The way the margin works is the exchange, it's like a bank account the exchange keeps. The exchange wants you to keep a certain amount of money with itself which is used as a protection against a potential default. This account is what is referred to as the margin account. The initial amount of money that you put in is what is called as the initial margin. Now, on a daily basis, you are running a contract. On a daily basis, at the end of the contract, the exchange would say, okay, if the counterparty were to exit from this contract, how much would be the profit or loss? So if there is a profit, that obviously if it's a profit for you, it's a loss for your counterparty. So your counterparty is debited, the loss account is debited, and the profit account is credited. And this carries on a daily basis, with the change happening on a daily basis. Every day there is a change that kind of happens. That is what is your daily settlement or marking to market. Now, given that in the loss, money is debited, your margin account balance might fall, and there is a minimum balance that you need to keep, which is called as the maintenance margin that has to be there. There is a minimum amount that you need to kind of keep in the process. If the balance falls below the minimum amount, you have what is called as a margin call. What does it mean? It means that the exchange asks you to put in more money in the account so that the minimum balance that you require is met, and therefore you have the ability to continue doing business. In the event the counterparty fails to put in money after a margin call, that position is closed and the and resolved. What happens? The counterparty who has not defaulted or who has not violated any condition is made good the amount by the exchange. The exchange then has this margin account balance. Realize that if the trader was doing business today, which means still yesterday the trader had everything in place, there was no problem. It is only today's loss that has caused it to go into the margin call zone, and they have not paid up. Now, therefore, the losses that will actually be exposed, open losses, is the losses for today less the balance in the margin account at the beginning of the day, which obviously is going to be a smaller amount than the losses today. Now, that is a small loss that the exchange has to bear. The exchange may have other legal means to recover these losses, but that is a small amount of loss that the exchange bears, right? And takes care of that. The exchange may have other legal means to recover this by filing a case against them and all that, but that could take a long time. The margin system also allows the exchanges to recover their losses, because after all, the exchange is promising them guaranteeing settlement and all of that. So therefore, the exchange right. So the exchange will kind of then square off the position with the margin call, or if the margin call is there, you put in more money, things are go back to normal, things work on the regular basis. And finally, what is variation margin? Variation margin is the amount of money that is there or that you have to put in on a daily basis. So this change that the amount you're putting in up and down on a daily basis is what is referred to as the variation margin. Now, just this is how this works. Just think of this as an example. I know some of you might get confused with the rupees. Just replace the rupees. I mean, because I was looking at an Indian example at that point, just replace the rupees by dollars. Right. So let's say the price of a futures price of a share of a company of a contract of X is $1,060 per share. The contract size is 500 shares, and the investor wants to buy a total of 1,000 shares. Therefore, the broker will, therefore, they need to buy 2 contracts, each contract of 500 shares. The broker will require the investor to deposit the money in what is called as a margin account. How much will that be? Let's say the amount that must be deposited at the time of the contract is first entered into his initial margin. This is determined by the broker. Let's say the initial margin is $20,000 per contract or $40,000 in all. At the end of each trading day, the margin account is adjusted to reflect the investor's gain or loss. That is what is known as the marking to market due to daily settlement. How does that happen? So let's look at this Next slide and you will realize what happens. Okay, the investor is also entitled to withdraw any money from the balance in the margin account in excess of the initial margin. And they also have a maintenance margin, the minimum balance, that is set at somewhat lower than the initial margin, which is $50,000 per contract. You have 2 contracts, therefore $30,000. And if, as I said, if the balance in the margin account falls below the maintenance margin, there'll be a margin call when the investor is required to top up the margin account. The extra funds that are deposited are what are known as variation margin. So let's say this was started on December 13th and on December 20th it was closed out and the closing position was $1,020 was the share price of a share. So this is what it is. You bought 1,000 stock futures of X on December 13th at $1,060 per stock per futures contract and sold on December 20 at $1,020 each. So what do I have? I have the prices, I have the days 13, 14, 15, 16, 17 and then 18, 19 was weekend and December 20. So I have 6 days. The corresponding settlement prices or the market prices are given to me. So how much have I gained? If you look at it, how much are you gaining? On the first day, you had bought it at 1,060. Market has gone to 1,065, which means you have gained 5,000. 5 into 1,000, right? You started off with your balance with $40,000. This 5,000 has got added. Therefore, you've got 45,000. Next day, the price has dropped from 1,065 to 1,041.1. How much have you lost? So in each contract, you are losing $23.9, and you have 1,000 shares. Therefore, you've lost 23,900. Therefore, from your 45,000, it falls to 23,900. The balance of 23,900 is lost. So your balance falls to 21,100. Your maintenance level is 30,000. So you are required to put in more margin. You put in 18,900 to get it up to 40,000. So the variation margin becomes for 18,900. Next day the price increases. You benefit. Nothing happens to the variation margin. Price falls by a small amount. The margin balance falls, but it is still well within. So the cumulative variation margin is there. On the 5th day, the price drops by a huge amount. And therefore, you lose, by the same logic, $25,000, $25,450. So your margin balance from 40,700 becomes 15,250, which is way below the maintenance margin. Margin call is there. You put in 24,750, so that the margin balance the cumulative variation margin is now. You had earlier put 18,900. You have now put 24,750. So these together adds up to. So today you have put in total of 43,650. And with the 24,750, your balance in the margin account now is 43,650. So therefore, now, so you have put in that. So that's, sorry, I have made one small mistake. There is a small mistake. The margin balance is not 43,650. The 43,650 is the cumulative variation margin. This amount is how much? 40,000 is the balance margin balance. So I've made a small typo. Please note that this value should be 40,000. And this is the amount. No, this value is correct. So by putting this, I have 40,000. On this day, I'm making a further gain of 3,650. So the balance is now 43,650. So this is the total margin balance that I have. It is closed out. So on contract expiry, what will you get? You will sell the contract, 1,000 shares at $1,020 each. So that is $10,020,000. Your buying price was $10,060,000. So your loss is, net loss is $40,000. How much money have you already paid to the member margin account? Initial margin plus the cumulative margin, which adds up to 83,650. That's what you paid. You are losing 40,000. So how much will you get back? $43,650. Now I did not have to do this because at the end of the day I have squared it on a daily basis. So this balance on the margin account is what I will get back. And that exactly matches up with this, which is 43,650 as the amount that you have. And that is that is how the margin balance account operates. Right? Okay. Just quickly one thing. So you have an exchange clearinghouse. The exchange is an addition to the exchange. The clearinghouse is an addition to the exchange and acts as an intermediary. What does it do? It guarantees all these transactions. So brokers who are not members of the clearinghouse can only do business by accessing the by routing their business through a member. The main task is to kind of track all transactions that take place so that it can calculate the net position. Now, just as an investor is required to maintain margin account with his or her broker, a clearinghouse member is also required to keep margin with the clearinghouse, and that is what is known as the clearing margin. Additionally, exchange house calculates number of contracts on a gross basis or on a net basis. So a gross basis is adding up all the contracts to the client, and a net basis is by allowing offset for proprietary trading against each other. So, if you've bought and sold, your net position is looked at as opposed to the gross basis where all of them are added up. There's some other terminology that remains in the futures market. Open interest, which is the total number of contracts which are outstanding, which is the number of long positions or the number of short positions. The settlement price is the price at which the contracts will be settled. Typically, the final price just before the close of business. And volume of trade is the number of trades in one day. So when a new trade is completed, the open interest may go up, go down, or remain the same because dependent on the current number of contracts that are kind of coming in. As I said, financial futures on notional assets like financial prices, stock indices are settled in cash because you can't deliver the underlying asset. When the contract is settled in cash and it is marked to market at the end of the last trading day, all positions are closed and the settlement price on the last day is the closing spot price of that underlying asset. Some exchanges ensure all contracts are traded in cash, settled in cash, but that's not mandated. I've already talked about this, so I'm not going to repeat this. This is again what this definition of this margin are. The exchanges, the regulators specify margins between the clearing members and the clearinghouse. So it's like the central bank decides the rate at which it will give to the banks. The banks then decide the rate at which it will give to you and me. Similarly, margins at all other levels are defined by the exchanges. And the exchanges also define what kind of assets will be taken as margins. Typically, government securities, treasury bills, and cash are acceptable things because they also need to have some amount of both guarantee that will not default and there's some amount of liquidity. Also, volatility defines the change in the market, change in the margin. Now, this is the slide that I was trying to talk about in clearinghouse. So you are here. You are a customer. You are here. You could either go to a non-clearing member or a clearing member. It's only the clearing member that gives the transfer. You buy, your deal is routed through this way to the non-clearing member, to the clearing member, to the clearing house. On the other side, the guy who sells also has the same transaction. Settlement happens at the clearing house stage, and the information is passed back on both sides to close the contract. Simply like a banking settlement thing. These are the types of orders that you can have in a market. These are like, when can you execute it and then all of that. The standard contracts that you have in any market condition. They are the same as in futures markets also. The last slide, and I'll stop with this slide because there are examples and you can look at it later on your own and we can discuss them tomorrow if you want. There are three types of traders that you can have. You can have what are called as pure brokers who do not trade on their own. They're like agents. They only do the trade for somebody else. Then you have flow traders who are also called proprietary traders. They trade for their own accounts only. And then you have dual traders who can do trades for others and who can do trades for themselves. Most markets do not permit dual trading. That is because there is a conflict of interest. I am doing a trade for you and I am also doing a trade for my own portfolio. I have an information, I get an information, and I know that the information, only the first person will get benefit from this information. So there will be a conflict of interest. Who will benefit from this? Will I use it on my portfolio? Will I use it on your portfolio? I can just use it once and on one portfolio. And therefore, there will be a conflict of interest. To avoid the conflict of interest, dual trading is not permitted in most markets. Finally, in most scenarios, both hedgers and speculators participate because, as I said, if hedgers and speculators don't participate, then like in the normal market condition, the markets will not survive and arbitrages may or may not be there, but hedgers and speculators will actually have to be there in the context to kind of survive. Okay, that gives you an idea of the futures market. My request is quickly go through the problem. There are a few problems that I have listed out here. There are, I think, so we are on slide 31. So, how many are there? So there are about 10, I think 5 or 6 odd problems that I have done out here, and I have given the reason, I have explained it, and for each of the things I have kind of solved it. So you should be able to go through this and look at it. If you do not understand any one of these, please look at it and please tell me tomorrow. I will then kind of again explain that problem to you in detail. But in general, I have kind of given, there are 6 problems that I have solved out here. That should also give you some idea as to how this thing works out in practice. Okay? Is it fine? Is it fine, guys? Okay. Okay. Thank you then. We'll see you tomorrow. We'll see each other tomorrow at the same time. Okay. Enjoy your Saturday. Bye.